You've probably heard that you can't deduct expenses incurred before your corporation existed. That's generally true, but it's not quite the full story. There are certain types of expenses you can claim even if the receipt is dated before you incorporated. The important question here: was this a cost of creating or equipping the corporation, or was it a cost of earning your income? If it helped create the corporation or equip the corporation can typically deduct it. If it was a cost of earning your income before the corporation existed, though, that stays out of the corporation. So let's start with an easy one: the cost of creating the corporation. Here, we're talking lawyer and registry fees. Those are clearly the corporation's own costs. So if you paid them personally, the corporation can pay you back and claim the deduction. And as well, the first $3,000 is fully deductible right away, which covers most incorporations I see. Now, a little more complicated are the costs of equipping the corporation. So let's say you bought a laptop or medical equipment that you intend to use for your PC, but you bought it the day before you incorporated. This one is treated as a purchase, not a reimbursement. So the corporation buys the item from you. The purchase price is what it's worth today, not necessarily what you paid for it. And then usually the corporation will record the amount against your shareholder loan, which you draw out tax-free. The corporation records the asset on its books for the purchase price and then claims depreciation as it uses the asset to earn income going forward. Now, the trickiest category is the general cost of running your practice before you incorporated. So these could be professional dues for the earlier months or a course you took a week before. Now, those are legitimate practice costs that you pay to earn your income, but they were incurred. They were incurred before incorporation, so they belong on your personal return for that period. And putting them through your corporation could actually backfire. If the corporation pays you back, CRA could tax you on a personal benefit and deny the corporate deduction. The best way to think about this: the incorporation date is your all-important dividing line. Before that date, the corporation simply did not exist, so it can't deduct expenses that relate to that period. Now, expenses that straddle this date, like let's say you have an annual payment where you have months on either side, usually you can prorate that, so keep your receipts. To recap, the important question really is: what type of expense are you dealing with here? And in cases where you're not sure, ask your accountant. I hope this was helpful. Thanks so much for watching, and I will talk to you soon.